Market capitalization is one way to measure the size of a company, but in my opinion, it makes for the simplest yet one of the most effective methods to avoiding a boneheaded investment decision. Now, market capitalization, or your market cap, shows the dollar value of a company's outstanding shares. To get this number, you simply multiply the company's total number of shares by the price of each share. As the price of the stock changes, or the number of shares outstanding changes, so will the company's market capitalization. Companies can then be sorted into categories by size or capitalization, with the three most common tiers being small, mid, and large cap. And while small, mid, and large cap are your traditional categories, other categories do exist, such as nano cap, micro cap, and even mega cap. Generally speaking, these ranges tend to drift a little bit higher over time as asset prices continue to increase. So how do we use it? Let's make an example. Company A, we'll say, has 100 shares outstanding at $5 a share. That would give it a market capitalization of $500. Company B, we'll say, has 20 shares outstanding, but they're at $7 a share, which would be 40% higher. Despite that, it has a market cap of only $140, meaning that despite having a higher share price, Company B is actually worth significantly less money than Company A. Now, it's worth noting that market cap almost exclusively refers to publicly traded companies. The reason for this is that you simply would have a difficult time coming up with an accurate valuation of an individual share of a private company, since they are quite literally not available to the public for purchase. The simplicity of the market cap formula makes it a convenient way to quickly compare the size of different companies based on where they are trading at a given time. But also keep in mind that there are more nuanced ways to value a company, like a discounted cash flow model or even a dividend discount model. Well, this is all great, Dave, but why do market caps even matter? In my opinion, market cap can be helpful for two main reasons. Number one, market cap is a quick way to get a possible feel for the size of a company. Number two, market cap might be able to give you insight into the riskiness of an investment when comparing it with other factors. So, for example, in June of 2020, electric vehicle company Nikola had reached a market cap of $28.8 billion. On that same day, Ford was also worth about $28.8 billion. So what does that matter, and what's the difference between the two? Well, Ford was the mature, established company with billions in revenue, and Nikola was a pre-revenue company with an unproven product, and this is before the CEO, Trevor Milton, was later forced to step down and eventually charged with fraud. Hindsight is obviously 2020 here, but had you taken the time to compare market caps in June of 2020, all other factors considered, I just don't think there's a single person in their rational mind who would have bid Nikola up to the value it once held. I don't say that to mock those who did bid the stock up, but my philosophy has always been, and continues to be, to try to learn from others' mistakes rather than making them myself. But just as one final reminder, guys, I'm an individual investor. I am not a financial advisor. This should not be considered your financial advice. All opinions expressed are my own, are subject to change during mood swings. My name is Dave, and this has been The Market Board.